like we explained in day one, these actually happen from credit transactions, not the credit card that we did last time. Okay, that was, we said, is different. That's related to the financing companies, financing a person, and company pays you and you record the credit card expense, whatever. We said these credits happen between you and the customer. So something personal credits. I trust the supplier, so we exchange this between the supplier and us, and that how these receivables happen. So I don't get cash. Instead, they will pay me the money later. Okay. Other formats are interest receivable, rent receivable, tax refund receivable, meaning it's an interest I will receive, rent I shall receive, tax refund I shall receive. Okay, same format. I did not get it now as credit, I'll receive it later. Okay. So companies which sell on credit, see, sell on account means selling on credit. Not again, not the credit card, means I have a record with my customers, right? That's the credit I'm creating. I have all of you in the class, 20 of you. Let's say you are customers, okay? So I need to keep record of those, right? Separate account for each customer. Whenever we did before, actually, you had names for the companies, if you remember. So you say accounts receivable, Ani. Accounts receivable, Sona. Why? Because these are different people. This one owes me 1,000. This one owes me 500,000, whatever. So I need to keep record of each one. I don't say just account receivable this much. We did this in chapter 1 and chapter 1 and 2. I just say accounts receivable. But in reality, each one of those accounts should be related to a separate customer, separate individual, separate organization, or whatever, right? Also, the companies doing this has to be ready for bad debts. What's bad debts? These people owed me money, right? This person would not pay, right? He went bankrupt, whatever. He died and is going to take years to settle that account. I don't know, but for me, I have to be ready for or accounted for what we call bad debts, okay, and how to handle that. Okay, now this, for example, how we maintain the individual ledgers. Okay, so here I have my own ledger, accounts receivable, right? But for each of my customers, so this is a customer, RDA Electronics, Comp Store, right? Each one has its own ledger, sub ledger. Okay, so here accounts receivable in total $3,000. What? 1,000 owed by electronics, and then Comp Store owes me 2,000. You see here? So 1,000 here, 2,000 here. The total of the subs are 3, and that's my general ledger. Okay, and then what happens in here, whatever happens to these accounts, okay, this one, for example, had more. Okay, so see here, 950 added, so 2,950, 3,950 is my total in here. So whatever happens in here actually is reflected in the general ledger, but I do keep separate ledgers for my sales, my accounts receivables, my accounts payable, even accounts payables, right? I do buy from different suppliers. I do buy from 5 suppliers, different things. So I have 5 accounts payables with these suppliers. Okay. So also that I have to keep track of. Like we said, other than maintaining the subledgers and accounting for different suppliers, different customers, different whatever, we said we need also to maintain or to be ready or deal with bad debts. Okay? What are bad debts? We said we have some customers who are granted credit, means you said, okay, come take $1,000 worth of my merchandise, and then they don't pay you. Okay? So they do not pay what they promised or what they owed. Okay? And these accounts or customers called uncollectible accounts or bad debts. Okay, so these are bad debts. Now, we need to calculate and value these debts. Okay, I have to maintain an account where I put all the losses that happens from bad debts. Okay, so the methods for this, the first one is called the direct method, which does not satisfy GAAP. Remember what that was day one, and we repeated it. Generally accepted accounting principles. Okay, so in day one we said we have 5 principles there. This is 1, 2, 3, 4, 5, and we always work according to GAAP. So as long as it does not satisfy GAAP, then I'm not using this method. So you don't have to worry about it. We will not talk about it. We will not explain it because we're not going to use it.
Stop.
Okay. The second method is the allowance method, which satisfies GAAP, meets the GAAP requirements. So we are going to use the allowance method. Okay. Allowance method is 2 ways of doing it. One, income statement approach. What is an income statement? What is in the income statement? Income statement means my income. So it's a percentage of sales. Okay? And we'll see how is that done. What does that mean? And the balance sheet approach. The balance sheet, what do I have in the balance sheet? I have the accounts receivable. Okay? So we create something called allowance for doubtful accounts, and we'll see how that is recorded, how that is posted. Okay? Do you remember when we did the adjustments, we had depreciation, right? And we recorded depreciation as depreciation expense, debit. Where did we close it? Accumulated depreciation, right? In this case, we have this one. I remember them because this is accumulated, this is allowances. So it both start with an A. Okay? So for depreciation, I say depreciation expense, and I close it in accumulated depreciation. Here, bad debt expense, allowance for doubtful accounts, AFDA. So this is our new account that we will be dealing with and working with. Okay? Allowance for doubtful accounts. Now, how to record the estimated bad debt expense? Adjustments for bad debts are made at the end of the accounting period. So at the end of your financial year, at the end of whatever, if you're closing the books after 3 months because you want to start another period for whatever, then this is when this adjustment is done. Okay, what do we use for this? We use the contra asset account called allowance for doubtful accounts, the one we just explained. Okay, AFDA, allowance for doubtful accounts. We are creating this. It's like a pool where I take from whatever accounts that are not paid. Okay, and we call such accounts contra asset account. What was also a contra asset account? Depreciation was contra asset. Okay, they accumulated. Why? Because this is your asset, and then whatever comes out of it, that's contra asset, opposite to the asset, takes down your asset. Okay, same thing here. This is taking of what? Of your accounts receivable. So accounts receivable is an asset. This is taking of your accounts receivable. So it's again a contra asset account. Okay. So an example. We will work on estimating the bad debt. Here is given to you just to show the entry, the transaction. Okay. So when I have this, it says the estimated bad debt for this company is so and so. What do I record? Bad debt expense, 1,500, allowance, 1,500. Okay, like I said, just the way we did with depreciation, right? I said depreciation expense versus what? Accumulated depreciation. See? This is bad debt expense, this is depreciation expense. This is accumulated depreciation, this is allowance, we call it for doubtful accounts. Okay, so this is how we record the bad debt expense. It's an expense, the way we recorded each and every expense, right? Rent expense, cash. Insurance expense, cash. So and so expense, accounts payable, and so on. Okay. So we use the allowance because we don't know who is not going to pay me. Okay. Whenever somebody doesn't pay, then we record this. So writing off a bad debt allowance method is what? Specific customer's account, for example, this guy, Jack Kent, is considered uncollectible. Okay, so the due date came, I called him, nothing there. I stopped by, place is closed, nobody knows anything about him. So I consider that as what? A write-off. What is a write-off? Just like I'm canceling that account. Okay, what do you mean cancel? When this guy purchased stuff for me, what was the entry? It was accounts receivable, Jack Kent, and sales 520. Right? So on the T account of Jack Kent, that's accounts receivable JK. Okay? Jack Kent, accounts receivable 520. That's his 520 debit for Jack Kent. Okay? Now, when I knew that the guy has disappeared, no Jack Kent, okay? He took the money and disappeared. See what I did? Usually, when I get paid, I say cash, right? So I'm receiving cash, and I make Jack Kent credit it. So I cancel him. Now, I'm not receiving cash, but I have to cancel his account. I may have to make his account zero. I cannot keep an open account for somebody who's not going to pay me. So here, he was debit 520. I'm making him what? Credit by 520. See? Allowance for doubtful accounts and accounts receivable Jack Kent. So 520. So I closed his account and made the balance 0. Okay? Where did I close this? I closed it in the allowance for doubtful accounts. Okay? Always try to understand how things are happening through your T accounts. See here? I want to see why I'm doing this like this. Why I'm putting him credit in here. Yes, because when he purchased from me, I said accounts receivable and sales. If he paid me, I would say cash and accounts receivable. So I received the money from him. Now he's not going to pay me. I still have to make him credit so that I cancel Jack Kent from my books, make his balance 0, and the amount owed will be in the allowance for the doubtful accounts. In my allocation of money that is not to be collected. Okay, guys? So I'm writing off this money. If I receive it, I will say cash. I received the cash, 520, and accounts receivable, Jack Kent, 520. Okay, and that again made his balance 0. But in this case, no, he's not paying me cash. I'm keeping his account as credit, but instead of the cash, I'm saying allowance for doubtful accounts. And that closes his account. Okay? Now, what is this note? See here, guys, here we recorded the expense. I estimated that over the year, there will be $1,500 bad debt expense.
หนูใสนะ
Whatever happens through the year, I put it in here. Okay? So this an estimate we do, and we will see the two methods for determining the estimate. See here? The estimated. Why? Because we do this in advance. I don't know who's not gonna pay me over the year. Okay? Maybe 2 will not pay me, maybe 3, maybe 10 will not pay me, maybe everybody will pay me. So this is an estimate. We estimate a percentage of my sales, of my accounts receivable. We'll see the two methods that 1,500 this year will not be collected. So that's estimated in advance. And over the year, whatever that I cannot collect, where do I put it? I put it in the allowance. I created the allowance in here, and then I use the allowance to write off my what? Bad debts. Okay, guys? So first step, we created this allowance, and second step, we are writing off the debts which are not collectible in this created account. Okay? This is what I just explained to you. I should have looked at this. Anyways, so bad debt expense, this is what we created in the first transaction. Bad debt expense estimated 1,500, allowance 1,500. Here you see I created 1,500 allowance. Now 520 of it is written in here. You see, it's debited now by the debt of Jack Kent. So how much I still have in the pool? This much. My accounts receivable. This is all my accounts receivable. All of you owed me $20,000. Okay? This one here, okay? Alili is not paying me. So I did that, right? It came off. So I have this much of accounts receivables still. Okay, so everything you do, this is explained in the T account, and you can see what's happening. Okay, this is my overall estimated. This is gone over. This is still in the allowance. This is my overall accounts receivable. This is how much I lost, which I thought that is not being paid. This is how much people still owe me. Okay, in total accounts receivables. Now, a month later, Jack Kent called me. He said, "You know what? I'm sorry. I had an issue and I had a car accident and I had to go to BC and I'm back now. Things are okay. I want to pay my debt." Wow, good guy. Anyway, so first of all, what do I need to do? I need to create, okay, his account again, and then I collect it. Now, according to my books, Jack Kent owes me nothing, right? Because in the previous one, what I did was 520 accounts receivable, and I wrote that off in the allowance, right? I should put again Jack Kent owing me 520, and then I will ask him, okay, I'm getting the money. Okay, so first of all, entries are accounts receivable Jack Kent 520. I'm reversing this. Okay, I wrote off his 520 where in the previous entry in the allowance. Remember, it was allowance, and I made him credit so I can cancel him. Now I'm reversing this. That's the opposite of my previous entry. Again, accounts receivable Jack Kent 520. You see, I re-established his debt for me. And then I'm receiving the cash and I'm putting him credit here 520. So he is done. So this is easy. This is straightforward. This happens when the one of the accounts, one of the written off. See, this is a written off account. I have to reinstall the account, make Jack Kent owes me money, and then I get paid. So that illustrates to you what happens if the write-off is reversed. So I reverse the previous entry. This was my previous entry. See here, allowance was debit, Jack Kent was credit because I wanted this, the 520. I made this, I wanted this to be in here. So I wrote off his account. Now he wants to pay me back, right? So I have to make him again in here, owes me money. So then I put him in here again. So I have to install his debt again for me and then receive the cash for it. So that was the reverse of the previous entry. And then I record receiving cash from Jack Kent. Now, we said there are two methods, the direct method